Now, very briefly, today's session is being organized by the Climate Change Community Practice, and it's my great pleasure to introduce the new co-chairs for the working group, Matt Eldridge and Karen Kemper, who will also moderate today's session. Matt Eldridge is Senior Program Officer in Development Policy and Finance Team of the Bill and Melinda Gates Foundation, and focuses primarily on climate finance and policy in developing countries. Prior to joining the foundation, Matt worked for a few years at the Urban Institute, and before that, he was a consultant on US banking and asset management regulation, also worked at the World Bank. He has an MSc from the LSE. Karen Kemper, until recently, was Global Director for Environment, Natural Resources, and the Blue Economy at the World Bank. And currently, she serves as Special Advisor to the Chair of the International Standards and Sustainability Board, ISSB. She's also a Director on the board of IUCN US, and is also engaging as a Senior Advisor focusing on climate change and biodiversity. Karen holds a PhD in Water and Environmental Studies alongside MSc degrees in Nutrition and Integrative Health and Herbal Medicine. So we're very pleased. Larry and I are very pleased that the two of you are taking on this responsibility for running over the next year at least, and maybe beyond, the working group of the Scaling on Climate Change of the Scaling Community of Practice. Now, I also want, by way of thanks to the outgoing chairs, Amar Bhattacharya and George Zetkinese, to very much thank them for their participation in this effort over the past few years. Going to one more logistical issue that I might have mentioned earlier, and that is that there's a chat function, as probably most of you know, in our Teams screen today. And if you want to comment on anything you hear or ask questions to the presenters, please enter your comment or question in the chat function at any time, and the moderators will try and keep track of them and to have the panelists respond as appropriate. I have one more comment for today's session, and this regards the topic, private sector. The private sector role in scaling. It's an issue that cuts across all areas, not just climate change. And if you're interested in that particular aspect of scaling, you'll find that all of our other sessions over the next 2 weeks will actually address aspects of this challenge in terms of what are the key pathways for private sector scaling, what is the appropriate interaction between private and public efforts to support scaling, how can we mobilize private finance for developing the climate action, and what is the role of official funders and of foundations in supporting private sector engagement in scaling efforts. So with this, I think my role in today's event is completed, and I'll hand over with great pleasure and many thanks to you, Matt, and then from Matt on to Karen, to introduce the session in some detail and to start the discussion. Thank you very much, and over to you, Matt.
Great, thank you for the introduction, Johannes, and I'd like to extend a warm welcome to all of those joining today's webinar on scaling private investment in climate adaptation and biodiversity. As Johannes said, I'm going to offer a few framing remarks and raise some questions that I'm sure our esteemed panel will be well positioned to help answer. So there are a lot of numbers out there to describe how much money is needed to build resilience to climate change. UNEP, for instance, estimates it at a couple $100 billion a year. Regardless of the exact number, there are certainly a few points that seem to be broadly agreed. The first is that the amount of adaptation finance needed is large, and it's growing larger every year. The second is that the gap between finance provided and the finance that's required for adaptation is also large and growing. And the third, as with so many other challenges, public funds alone will not be enough to bridge that gap. So private investment has a big role to play in ensuring successful adaptation to climate change and in securing biodiversity. But what does that mean in practice? So we know a lot about the role of and opportunities for private investment in climate mitigation, but private adaptation finance is more of a black box. That's partly because private actors don't call these investments adaptation investments, and also because we just know less about the types of investments being made and where private investment is necessary and viable. But this is changing. Private actors, including households and SMEs, are already feeling the effects of climate change and already taking actions to adapt and build resilience, even if they aren't using that terminology. We have a growing recognition and understanding about the role of private investment in climate adaptation and biodiversity. Work is ongoing at the analytic and policy level to better understand private adaptation finance, where it's flowing, who's providing it, what it's investing in, and key to today's discussion, how to scale it. Adaptation investments don't need to just be thought of as defensive, zero-sum moves that try to protect value. They can also boost productivity and efficiency and open new markets while building resilience at the same time. Solutions to manage climate risks, climate shocks, and stressors are already in high demand. Think of efficiently cooling homes and offices, improved and highly localized weather data, insurance and other risk management tools, drought-resistant seed varieties, and nature-based solutions for water conservation and flood management. So what's holding back scaling? Do we need to increase and improve blended finance tools for multilateral banks, development finance institutions, and governments? Is there a science and innovation constraint where upstream R&D needs to be subsidized? Are we lacking the right financial products or highly localized knowledge? Are there financial, public policy or institutional disincentives? Is there a lack of private sector understanding of the business value of these investments and the cost of inaction? So, I mean, there could be a number of different reasons why we haven't seen the scaling that is necessary. To help answer these questions, we have an excellent panel for you all today, representing different perspectives within the private investment landscape. I'll briefly introduce each panelist. Each has a very impressive resume that I will not do justice to today, but you can read their full bio online. So first, reintroducing my co-moderator, Karen Kemper, who Johannes provided a bio to. Next, we have Elvira Lefting, founder and CIO of Finance in Motion, one of the world's leading impact investing asset managers with 3 billion euros under management across climate and nature strategies. Next is Tamer Al-Rahi, founding managing director of the Acumen Resilient Agriculture Fund, a $58 million impact VC fund investing in agri-startups in Africa. Next, we have Gregory Watson, a principal specialist for biodiversity and natural capital, climate change, and sustainable development at the Inter-American Development Bank, and leading the IDB's Natural Capital Lab program. And finally, we have Emily Mazzucarati, co-founder and managing partner of Tailwinds, an innovation studio focusing on accelerating innovation for climate adaptation and resilient solutions. Karen, the floor is yours.
Thank you very much, Matt, for this great introduction of our fantastic panel. And I'd like to really delve into these questions that you have raised for the audience and for the panel. So let me start with Emily. We're listening to Matt, who gave us all these different challenges that are going on in climate adaptation and on the biodiversity side. For you, what counts as adaptation, and how important is it to distinguish adaptation investments as distinct from just good risk management, given everything that's going on in the world?
That's a great question, Karen, and thanks for having me on this panel. I'll take a second to just provide where I'm speaking from. My work currently is focused on early stage investors and venture capital investors, but I've also worked many years with large institutional financial institutions, and so I want to provide the perspective from different investors. So first, let's talk about definitions. We need definitions. What are we investing in? What's the object? And adaptation comes across a wide range of sectors and activities that are already, where the private sector is already very involved. We're looking at, you mentioned AgMat, but also, of course, health, insurance, infrastructure, social systems. There are also needs in sectors where it's much harder to bring investors along, and we'll hear from Greg about that, ecosystems, biodiversity. And so there are needs for adaptation across all of these sectors. There are different types of investments and financial private financing that can take place. That can take place by way of private investments, but also infrastructure, project finance, but also equity investment, including in public equities, bonds, right? So you're going to find a range of instruments, blended finance, but also just pure private, pure commercial instruments. You're going to find this range of sectors and type of financial products and financial opportunities. So to your question about how do you distinguish and does it matter? The way the community of practice in adaptation typically look at adaptation investments is two things. One is they need to be activities or product economic activities, solutions that tackle a climate-related impact. So you need to be able to point and say, well, this is going to help with an increased risk of flood or extreme heat, or it's going to help with shifting temperature and how it affects my crop. Or it needs to be activities that build capacity and that build resilience across the board, across the system, right? And so you're going to have, it's a big Venn diagram with a lot of overlap with risk management, but also with just regular development activities. And those are not, that's not a bad thing per se, that those overlap. When you think about activities that tackle a specific climate risk, if you do flood management, that's risk management, but it's going to be adaptation if you are incorporating forward-looking projections and how climate is affecting the probability and the extent and the intensity that a flood or a certain extreme weather event might happen. So it's really the fact that you're also looking for the future and not backward looking that's going to make the difference with what's been standard risk management until now. And when you're looking at activities that are just systemic capacity building, it could be an early warning system for disease. If it's a vector-based disease that's going to get worse because of climate change, that's also adaptation. But again, you need to account for the fact that the risk might be exacerbated, it might change form, it might change region, and that's really the dynamic nature of that makes it adaptation. The last thing I'll mention is when you look at adaptation activities, you always need to think about maladaptation. In Europe, we talk about do no significant harm. So you're looking at avoiding activities that are going to generate a lot of greenhouse gas emissions or that may be locking in or encouraging practices, environmental or socially harmful practices. So adaptations is often going to be, or typically going to be context and specific to a given locale, and that assessment can be done case by case. And so the question of how we scale is really going to be how can you make those assessments easier so that the private sector doesn't have to constantly guess whether this is adaptation or not.
Thank you very much, Emily. I'm sure we will get a number of follow-ups and questions on that. I also wanted to remind our audience that about the last 20 minutes, we have questions and answers. So feel free to put things in the chat and we are going to pick up on that. And let me just spin this further then and go to Greg, because Greg, there are really massive gaps in finance for both biodiversity and climate adaptation, and in part a bit for the reasons that Emily was just laying out, because what is what and what do you really invest in and based on what criteria? So I wanted to ask you, how can, for instance, debt for nature conversions help fill that gap? And could you give us any examples of what the IDB has been supporting, for instance, in Galapagos and in Barbados, in order to scale and in order to start filling that gap?
Sure. Thanks, Karen, for the opportunity to be here. Also, just to maybe start with framing a little bit where we're sitting on this. When we're looking at both climate, but also biodiversity issues that our countries are facing. We're seeing the climate and the adaptation finance gaps, but we're also seeing the $700 billion per year up to 2030 biodiversity finance gap. And there's not enough public money that goes around to fill all three of these finance gaps. So first, we need to look where solutions can actually tackle multiple objectives, and nature-based solutions are one great opportunity. And then second, we need to be looking for areas that can crowd in private investment. And IDB and many development banks are looking at multiple different kinds of financial instruments, everything from biodiversity credits, carbon credits, different kinds of asset classes. But since we're here talking about scale at the IDB, one of the things that we started to look at were in a region with increased debt and debt that has at least increased by 100% since 2006, countries were very constrained. And so we wanted to see, could we use our policy-based guarantee instruments to crowd in private finance and actually, rather than the old traditional bilateral public debt swaps, look at the privately held debt. And what we try to do with these kinds of operations is to work with countries, take a broad look at their national commitments under their NDCs, under their adaptation plans, their long-term strategies, and their national biodiversity plans, and see where they can make new conservation commitments, new environmental commitments that are aligned with those plans, really go to the nitty-gritty of aligning ministries of environment and ministries of finance on turning those environmental commitments into financial commitments. Because what we do is that set of conservation commitments that we help to negotiate become part of a conservation agreement that goes into this wrapper of a guarantee that we will provide. And that guarantee is also predicated on policy commitments that will support the achievement of those conservation commitments. And so we can also provide some certainty to the markets when this all goes to an offer that the underlying monitoring and verification systems, that the underlying policy reforms that might need to take place to achieve these commitments are already being undertaken and that they've been met. And so in effect, we'll come in with partners, we'll provide a kind of our AAA rating to a guarantee to a country. With this whole package, they'll issue new bonds that will basically provide us savings and allow them to buy back more expensive bonds. And that savings will go into a conservation trust fund that will also help to achieve these underlying conservation commitments. Most of these conservation commitments also have very important adaptation impacts, and obviously a very long and important community engagement process as well. That's what we've done in Barbados. That was a project where 100% of the savings went to adaptation and conservation goals. And in Ecuador, where we worked in the Galapagos with the creation of a new marine preserve, but also with important adaptation impacts and fishery reform impacts in the Galapagos as well, where about half of the savings from the transaction went into, I'd say, the environmental outcomes. And so why do we think this is important for scale? By bringing an MDB into these transactions, which in the past didn't have an MDB, we've allowed them to go faster. It allows us to play a bit of an honest broker role and to bring these ministries closer together. And it allows us to also basically leverage the capacities of different parts of an MDB to support the needed environmental commitments, the financial commitments, and the MRV systems. And the impacts so far for us have been great. In the two transactions that we had, we saved $1 billion for the two countries. Over half of that went to conservation. We mobilized $700 million in addition to our capital. And in those two deals, with working with the private debt, we were able to surpass 22 public debt bilateral swaps. And so, in addition to the really important conservation impacts and the adaptation impacts, we see these, and we're very bullish on these as a way to really scale large volumes of finance quickly for these kinds of operations. And so I'm sure we'll talk more about the nitty-gritty of some of the things you need to do this later, but we're very enthusiastic about this as a scaling solution.
Thanks a lot, Greg, to give us an overview of this option. Surely, if you save the countries $1 billion, both countries together, if I understood you correctly, that is a major scaling exercise, both for the adaptation and for the nature space, and actually very much what countries are looking for. And so this is certainly an interesting instrument to continue following. With that, I want to go to Tamer, because you actually manage a fund for building resilience in the agriculture sector, which is particularly climate sensitive. So what then are the main challenges that you are seeing in scaling adaptation finance so it reaches micro entrepreneurs? What has been your experience that you could share with us, Tamer?
Sure, but first of all, Karen, thank you so much for inviting me and having me as part of this fine panel. Yeah, we see multiple challenges, of course, in the space we work in, and our fund, we invest in early stage companies, both in East and West Africa, with very innovative business models. Some of them are tech-based, some of them are typical brick and mortar, but all of them bring smaller farmers, business models that help them adapt and become more resilient to climate change. Excuse me. The biggest challenge we see is cost of financing. Those companies cannot live all on equity. They need to raise debt. They have to have a balanced balance sheet. Cost of debt is extremely expensive. Number one. Number two, in many cases, it's not even available in local currencies. So they have to borrow from international organizations. And then imagine an early stage business borrowing at 12% on the dollar. And then by the time they finance their products to those farmers and factor in all sorts of bells and whistles, the cost of financing to the farmer becomes in the upper teens on the dollar. So imagine a smaller farmer in Uganda or in Ethiopia that wants to install irrigation, which nowadays is not a nice to have anymore. It's a must to have. And then to finance that over 3 years at 18% on the dollar, factoring in local currency devaluation, etc., becomes prohibitive. The cost becomes really prohibitive. If you look at Africa today, less than 5% of farmers irrigate. If you look at some Asian countries with the same GDP, you'll find that number closer to 40%. With droughts, etc., now you see the difference between farmers who irrigate and farmers who don't. It's day and night, but it comes at a cost, and it's basically prohibitive. So cost of capital is an essential element that needs to be addressed and needs to be fixed as soon as possible. There are innovative solutions, but it requires, as Gregory mentioned, it requires multiple stakeholders to work together. I don't think there is a silver bullet. We have seen micro solutions, but I think we need more of macro ones. The second challenge I'd like to talk about is lack of enough technical assistance facilities. People always talk that, hey, you know what, we don't need those grants. As a matter of fact, no, we do. We do those grants that are actually targeting companies work in the private sector, working with those farmers in our sector. A good example is that we have a TA facility for our fund that we raise from funders, from donors, $5 million in TA that we are passing through to our portfolio companies to do things that we all want to see them doing, like having proper ESG policies and practices, having ERP systems, training their farmers, having gender initiatives. But these are expensive. And well, we are lucky to have that TA, but this is drop in the ocean. We need more. I'm not talking about our fund, I mean as a sector. We need more TA that helps those companies, do what we all want them to do in the ag space, but simply they don't have the resources to do it. Then TA becomes a very efficient and effective tool that delivers this kind of value to ultimately to the smaller farmers.
Thank you very much, Tamer, to lay out for us how this is seen actually from a farmer's point of view, and what farmers need and what you as a fund are trying to drive. We will certainly come back to that. For now, we are going to Elvira, and I think we've already, it's been very clear from our first three interventions here that there are so many ways of looking at the private sector. It's not a monolith. There are different pieces of it, and that's one of the things we very much wanted to highlight in this session. So then my question to you, Elvira, is what does private sector mean to you, and who do you target with your fund, and what motivates impact investors in this space, and how can impact investing be a scaling solution?
Okay, that's a couple of questions, and you asked me to put that into 5 minutes, so I'll be a little eclectic here. But as my predecessors also said, maybe some background is required here. So we manage as Finance in Motion various thematic funds in emerging markets to the tune of 4 billion. With a sizable share investing in mitigation, in adaptation, everything from infrastructure to regenerative agriculture, and biodiversity conservation. And we're doing that now for more than 15 years. So we're trying to really crowd private investors into emerging markets, into investable assets. And that means that for us, private funding, private investors are the bulk of what we raise now annually in the existing funds and new funds, so a little bit short of 1 billion. And they're absolutely key for the success of our work. To go to scale, to build the trust, and to really build investable assets that over time hopefully can be mainstreamed. And what is key for that, and I'm stating the obvious, but I think one cannot do that enough, is one really needs to understand their strategies, their needs, also their choices, their options. Privates have choices. You cannot force them to do anything. And for us, privates means pension funds, banks, asset managers, family offices, but also corporates. And very importantly, and I think that is now increasingly coming into the debate, and I really like that, we're not talking only about international capital and the global north investors, but also the domestic capital, the global south investors. That is a very, very significant, I think, development over the last years, because international investors are key right now for scale, and they're proven investors. But domestic capital, I think, is very, very important to solve problems like local currency, to solve problems of assessing operating environment risk. They don't require the same premium as others do, right? So this is important, and we're working on that. I would say we have a fairly good overview of trends and sentiments amongst private investors, but given the vastness of the market, whatever I'm going to say will also be just anecdotal. And anybody who wants to add and contradict is more than welcome. What I would also want to say for context is, and not that I like it, but it is also important that we remind ourselves of this. We have this debate at a time of high, if not highest, volatility. And that is driving risk premiums for emerging markets. Do we want it? Do we like it or not? It is a fact. While developed market opportunities remain very attractive, at scale, deep markets with many opportunities, and with very clear incentives. Let's just take the Inflation Reduction Act or the EU Green Deal. They help, amongst many other things, to allocate capital in a certain direction. And we don't have that as a frame in our emerging markets. And I think we need to be, again, mindful of that. So the interest of the private sector in sustainable investing, and as a subset of that, into nature, into biodiversity, into adaptation, is there. And large mainstream asset managers attest to that in their research, in their global studies of key investors. So the interest is there, the opportunities are being seen. So this is happening, and it's happening also for our funds. So we can absolutely attest to that. But of course, this growing interest needs to be seen through the same filter as climate mitigation or other topics as well. And that is that our experience has been, if you can build an asset class, if you can show that you can have a strategy that can be replicated, that helps to aggregate, that can really mitigate the risks. Having risks is not the problem, but you need a strategy how to mitigate that at scale. And ideally, it's proven or it's a function of, then I think you can really crowd private investors into this. I'm happy that I'm speaking after Tamir because we run a sustainable agriculture and sustainable practices fund. I use a shorthand now in Latin America, and we're doing that now for many, many years. And we've been able to crowd hundreds of millions of private investor capital into that fund to really finance the systemic change, to show farmers, cooperatives, how to really go into regenerative ag to really produce sustainably. And that has been possible because the way this has been designed, the way that risks have been mitigated, in this case also with the help of very targeted blended finance, that was convincing because the sector agriculture can be understood, and the subsector of doing what has been highlighted by other speakers beforehand, is it on water retention, on irrigation practices, all of that. That is something that can be understood, it can be measured as well, so that both the objectives and the outcomes are clearly understood. And we've built a monitoring framework around that again builds trust and gives comfort. So I think, yes, it can be done, but we need to solve the problem of the emerging market premium. Interest in this asset class is rising, but I think we need to have a better understanding of the various forms of private investors. For us right now on the adaptation side, nature side, in particular, asset managers and family office are very important. And we think one of the reasons might be that the asset managers are used to deal with the complexity and they have a system to really go deep, and family offices can be very focused. So if they have a target on this, then they will just go after it. So yes, can be done. It is happening, but in our view, scale, replicability matters to build trust, to build the comfort that this makes sense, and impact matters. But so do returns, so do robustness, so do other things, and that is something that we all collectively have to work on. Thanks.
Thank you very much, Elvira. So let me pick up on what you just said and what all of you said in a certain way, and let's have a full round of all of you to respond. Now, if you would like to pick up on anything that anybody else said, please feel free to also do so. There was so much content in everything. So my question would be that we often hear that changes in public policy are needed in order to crowd in the private sector. And actually, you all have kind of thankfully steered away or of that topic a bit and have touched a bit on what the private sector needs to see. And Elvira, you just mentioned, yes, one also has to have returns, and one also needs to see what the strategy is of the private investors. Otherwise, they will not come. But what is it that you would either feel that the private sector might need to change, and would there be a chance that that would even happen, or that you wished could be changed in order to go to scale? Are there things that can also emanate from within the private sector writ large as you have been treating it, or is it rather what would need to be done on the public policy side? Floor is open to all of you.
What I can maybe quickly throw in, oh, sorry, Emily, go first.
No, go ahead.
It maybe builds on what was just said, and I was in a domestic capital of what is it called, workshop just before this, where this was raised as well. Until today, my understanding, if it has been changed, please correct me, but the GEMS database of the multilateral development banks has not been made publicly available. And I think data is the language, information is the language of private investors. If you want them to get not only a feel, a robust analysis of the true risk, not the perceived risk of emerging markets, then you need to give them data, you need to give them information. And who, if not the multilaterals, have been in these markets for decades? We've been in there as well. We're contributing to the database. Others have been there. I think it's vital that we share this data pool to solve the remarkable riddle of the perception of emerging market risk is much, much higher than it actually is in reality. So let's talk about it, because in the absence of that, the hurdle that we have to overcome to bring capital into something that is perceived higher risk has less risk-adjusted returns and is ridden with complexity. We haven't even talked about compliance today. So it matters if you can build transparency. It matters if you can speak in the currency of trust, which is data and information. So I think this is really core, and it's very quick to fix, and it should be a mandate of the multilaterals to really work on that. And it is not a new thing. I'm just repeating what other private investors have said already. So that's just a quick reaction. Thank you.
Well, I can build on that.
Thanks, Elvira. And Emily, you wanted to say something.
Thank you. Yes, I was going to build on Elvira's point that the private sector needs data and makes generally fairly rational decision. Can I make money here? Can I make money over by lending money, by investing, right? And so if we go back to first principles of markets, is there demand? Is there supply? And I think when it comes to adaptation, we have a big demand gap. So who are the buyers? The buyers here are going to be the organization that hold assets that need to be adapted, right? So it's going to be local and national governments, corporations, households, and SMEs. And to Matt's point earlier, we're seeing households and SMEs actually spend money towards resilience because it's hurting them right away, and they're making imperfect decisions based on imperfect information. But what we're seeing is local governments, national governments probably as well, and corporations moving very slowly from the point where they understand there is a need to adapt and to understand what exactly it is that they need to do that's going to be the best way for them to spend money on this, to understand the return on investment on spending money on adaptation or resilience investment or program versus doing something else that maybe addresses a more urgent, immediate, or salient need. And so from my perspective and the work that we do with Tailwind is also working with the demand side, with corporations, help them move from I have a problem, sort of generally speaking, with climate to I need a certain product that is going to have this type of performances, that is going to solve this specific pain point under these circumstances. And only when you have those very clear market signal about what it is that they need and that there is money that is going to be spent on those things, will you see supply? And only then will you have investors actually come in and support the companies that are providing those products and services. And so demand is a massive gap. Supply is also a problem, and Tamer spoke to that very well as well. You need to support the innovators, the entrepreneurs, the brick and mortars, pop and mom shops, who are going to be able to deliver solutions, products, and services, but right now are not getting that clear demand signal, don't have the capital to develop those products and services. And to one of the points made earlier, we also need to do things better and smarter, and we need to leverage technology and scientific innovation to have better ways to deal with those impacts. And right now, this is not an area that is being sufficiently invested in by the public or the private sector. And so you really need to think about, how do I get demand? How do I get supply? And the investors will absolutely show up when there is a clear market. I think we lost Karen. Matt, are you on backup?
I wanted to jump in to answer the question, so maybe I'll just go ahead while Karen comes back.
Self-manage here.
Because for me, I think there's three areas where I think either international public policy or domestic public policy can come in, international being MDBs, right? And the first for me is on the MRV systems, and that would be in the domestic arena. I think in the climate side and with carbon, I mean, we really saw where we had to have domestic inventories and domestic systems, right? And I think we're less advanced in the adaptation, and especially in the biodiversity area with robust MRV systems in the national arenas to be able to report on what are the impacts. And I know we spend a lot of time working with countries to help to both get those set up with the right systems, but also really to make the case that they should be set up within ministries of finance and not ministries of environment, with the argument being that these are actual tools for leveraging private finance into the country. And so that's one. And another for me, and when we talked a little bit about this in our pre-call, is the atomization of key performance indicators and metrics between different disciplines and different sectors of this discussion. And so you have countries that are working on various different green taxonomies and biodiversity taxonomies and adaptation taxonomies. You have scientific organizations and NGOs. You have MDBs that are working with different products. You have ISSB and TNFD and TCFD, and these are all on different, they're all having different discussions that are somewhat coordinated, and some of us participate in different pieces of them, but they're not all moving in the same direction. And I think given the the multiple crises that we're in between climate and nature loss, we don't have the time to waste for these to sort themselves out. And so there's room in the public policy sphere to try to sit down amongst those different actors to align these KPIs to something simple that could be used in a bond issuance, that could be used by private investors, by corporates when they're doing their reporting, that is more standardized and more aligned across different disciplines. And then the last I'd say is policy coherence. And that has a lot of different meanings, but it's something we see in some of the deals between the different ministries of finance and environment and others. First, how do we look at subsidy reform and repurposing of subsidies? I mean, so filling some of these finance gaps, we can do all we want on bringing in new finance, but it could be wiped out by one bad subsidy that actually creates a negative impact that far surpasses the positive impact that we're trying for. And so we need to try to repurpose some of those subsidies on one side, valuing the impacts and of these different kinds of projects. And then a good example is, sometimes this comes from a deal. We see it in our debt for nature conversions. Other times it comes from the government itself. Chile has created this natural capital committee. It's comprised of Ministry of Finance, Ministry of Economy, Ministry of Environment, scientific organizations, and the central bank is an ex officio member. And the country itself is bringing together this group to create national accounts of biodiversity, to do valuations. This is informing the Ministry of Finance and how it can structure new regulations for financial products around nature for the private sector. It's looking at how they can do different kinds of emissions of different financial products. And it's kind of cohesive effort to really tackle all of the market making instruments in one place. And so I do think we could start to see this coming together. So that's a bit, I think, our perspective from the MDB world. And the last is the MDBs themselves are coming together to try to figure out, like, how do we measure what nature positive finance is for ourselves, because we don't even have a definition amongst ourselves as to what that is. You know, we have it for mitigation and adaptation, but if we're not tracking it, it makes it, I think, also hard for others to try to align.
Okay, thank you, Greg, to give us the perspective from the IDB point of view. Is there anyone who wants to follow up on that? So let me then ask you a question on what do you consider in this regard with regard to scaling? What do we make out of that from your different perspectives? We've heard the IDB point of view or the MDB point of view, and also the needs to have them to have the MDBs engaged and play that catalytic role. What else would you see in terms of scaling, and perhaps if there's anyone who might want to venture into looking specifically at Tamer on the ag side? We know that agriculture is just so important in the context of climate adaptation, but also the linkage to nature. How do you think you could further scale from going from the small entrepreneurs to a national and even global level?
It's an excellent question, and one of the things that we're discussing all the time amongst different stakeholders is one of the barriers for, and we always think smaller farmers, because we're in Africa and 80% of the ag sector is built upon smaller farmers, and we always talk about how the subsidies or the lack of subsidies impact growth, impact adoption of new products and practices. And we have success stories, and that we always refer to. There are some bright spots on the continent for good subsidy programs, but let's face it, African governments don't have the balance sheet to support a proper subsidy programs for farmers like what the EU does or the US does. Of course, every time, trust me, every time we talk about subsidies for African farmers, we are accused of distorting the market, calling for market distortion. And we all forget that farmers in other parts of the world that's fairly more developed than Africa, without naming a few, where farmers are fairly subsidized, right? $40 billion in the US, 40 billion euros in the EU go towards, and that subsidy, is well spent and helped growing, the sector. And we need those kind of programs in Africa. You look at, actually, one of our portfolio companies ran a very interesting pilot funded by donors in the UK, to see if the price or cost of irrigation drops by 25%, how would that affect adoption of irrigation, or specifically solar powered irrigation? And the velocity of selling that product increased 3x. Imagine dropping the price by 25%, increasing the adoption of irrigation amongst farmers by 25%. At the same time, you see reports by organizations like Darberg telling you that if Kenya invests $200 million on solar powered irrigation, Kenya can reach food security in 5 years. So you think about it and say, oh, 200 million, that's like peanuts. Yeah, that's peanuts. But guess what? The Kenyan government doesn't have the balance sheet to support it. So that's a vicious cycle that we keep talking about how we can grow. So now it's about growth. How can we have farmers adopt more of those climate smart products and services, so ultimately we can reach food security for African countries? But it all goes back to the cost, and the cost is basically prohibitive. Some people say, we need more land in Africa, or we need GMO in Africa. As a matter of fact, just for the land that we use right now, if you look at the yield gap, which in some crops is up to 80%, 80. Just fixing that yield gap will take us a long way. Thank you.
Thank you, Tamer. I see Greg writing very furiously. Any thoughts on that? Because it also takes me to the thought of blended finance, of course. Where would such subsidies come from in the context of poorer countries, or what we heard being laid out earlier by Greg on being able to crowd in other funding that then can go back to that type of finance. So any thoughts, Greg, that you have on what Tamer just said?
I do, although I was actually writing notes to Johannes's question in the chat. But on the subsidy question, this is something we've tackled in a few different deals and also more broadly. For example, in the Ecuador debt for nature conversion, with different fishery restrictions and changes to the fishery laws, you will have different impacts on different populations. And one of the things that we looked at was, is there a way to repurpose some of the subsidies that are currently given to fishery populations? For example, if they're not going to be fishing with certain equipment in certain areas, can subsidies be repurposed for retrofitting boats that will allow them to fish in different areas, for doing valuation studies of the impacts of the policy changes and the subsidy reforms on populations, and then creating what we were calling kind of just transition plans for the subsidy reform for these populations as well, that could be paid for through the proceeds that were going through the Conservation Trust Fund that were generated by the deal. And so it is something that we were looking for in that specific deal. And then there have been conversations with a number of actors kind of right now in the context of the Kunming and Montreal implementation of starting to look with countries with Biofin and other actors as to not starting with the most complicated. We probably wouldn't start with agriculture subsidies in large countries, but are there other subsidies that you wouldn't necessarily completely take away, but you could reform? We saw, for example, there's cases in Mexico we've seen where if you actually were to just pay fishers to not fish for 2 years, the population of a scallop could rebound to such a state where you could at the same time invest in some of the value chain infrastructure and create this export potential, and it would allow the time for the fishery to come back together. You could put in some sustainable practices and actually create a much more profitable and sustainable long-term solution for the community. It's actually much less expensive to just pay those fishers the 2 years worth of their salary while that fishery rebounds than it is to pay for the myriad social programs that it costs the government currently that they're providing as social supports because the fishery is not doing well. And so doing that kind of economic analysis, I think, can be interesting if we can do it in other sectors and other areas. But it's very complicated. And it actually, if we're talking about gender, the most interesting piece of that example was that the people that needed to be most convinced were the wives of the fishermen who said, look, I've got a family at home, I've got groceries to buy, you need to show me that this is really going to provide me the money I need to run my household in the short term. And so that they were the key decision makers in this kind of scheme. So just to put the gender lens on it as well.
Thank you, Greg. And anyone who wants to continue discussing the gender lens will be very appreciated too, because that is a big topic actually on both the adaptation and nature side. But I'd also like to link this to something that Emily said earlier. Emily, you mentioned that adaptation is very specific to individual locales. And wouldn't you consider that perhaps a barrier to scale? How do you standardize investment opportunities to scale while you at the same time customizing solutions? What's your take on that?
Great question. And let me speak first to your first question and keep the gender lens in a minute and the blended finance approach. I just want to flag one great example of how that can work and how you need everybody around the table to bring very meaningful solutions. So I'm the board member for Climate Resilience for All, which is a gender lens nonprofit focused on developing programs, in particular around extreme heat. And one of the flagship innovation of Climate Resilience for All is parametric insurance for income for women in the informal economy, with projects being rolled out in South Asia. And so what that looks like is working closely with an insurance company who has done the hard work of figuring out what kind of product, how to price it. There is a little contribution from the women who buy the insurance. And when the temperature hits a certain level and they just can't go out and work because it's so hot, then they get coverage for part of their income for their day, so they don't completely lose income on days of extreme heat. And the way this works is you can't actually, the way it's set up in this current market, make money out of that product. And so philanthropies come in and fill in the gap so that the insurance can run its business with a reasonable sort of cost plus margin. And we're able to offer this this product that uses market mechanisms, but also requires some blended finance to make for the shortfall from an economic standpoint, looking at the overall product. So this to say, going back to innovation can take many shapes or forms. Greg mentioned some really great programs. There is a lot of room here, and someone mentioned in the Q&A parametric insurance for floods, but that applies to every other hazards. There's a lot of room to work a lot more closely and create new financial and insurance solutions that will help address the needs and that leverage the power and the reach and the tools of the private sector, but that may need that extra input in terms of public or philanthropic money. Now to the question of how do we overcome the eternal question of it's local and it's context specific, and therefore, how do I know if this is adaptation? So there are some really interesting initiatives that are happening right now that are going to be rolled out over the coming months that are probably more targeted, but not exclusively to investors in the global north. So one is some of the work that we're doing with support from Climate Works and with other partners on really building a taxonomy that helps identify the object. It's not by any means a way to identify for sure what is adaptation or not, but at least it helps overcome that initial, like, what is adaptation? What is resilience? How do I invest into that? How do I invest into a seaworld kind of question, which comes up a lot, and really provides that expensive picture of everything that is potential adaptation, investments, or financing. There's a framework for adaptation investments that is about to be released by the Global Adaptation and Resilience Investor Group in New York, in partnership with some large financial data companies. And part of what they've looked at is how do you invest in, how do you identify adaptation and resilience companies in public markets? And there's a set of tools and questions that help provide guidance. You're not going to know 100% how a given product or service is being used and deployed on the ground when you invest in a company that provides those products and services. But at some point, there's also a little bit of a trade-off of, if you want to bring capital at scale, you're going to have to leave with a little bit of imperfection, because if you're looking for perfection, you're not going to get the scale. And then last but very important initiative run by the Climate Bonds Initiative, which has brought a number of standards for green bonds, very detailed analysis. And so the work that CBI is doing, that we're doing through the advisory group, is developing eligibility criteria at the investment level, very detailed, to be able over time to develop a white list of activities and products and services that are going to be deemed adaptation positive under any circumstances. And a second, the sort of a gray list, if you will, it's not the official name, that will help understand what are products and services that are likely going to be adaptation, but you want to check the local context. And then what are those where you really probably shouldn't do them unless you have very strong, compelling reason and you can mitigate what are known impacts of certain approaches or measures or activities. And so that's going to be rolled out probably towards the end of the year, going into next year. And that's something that's critically needed on the market so that we go from this constant generalized ambiguity to a world where there is clarity on a number of adaptation opportunities and there is clarity on where you need to do the extra legwork. And not to caricature, but investors like simple. Like if there's no extra homework, they make more money. So simplifying and clarifying is a really key enabler for scale.
Thank you. A lot of really good inputs, especially I like the white list and the gray list approach. Can see how that could really facilitate. In that context, we had a question in the chat, so I'm picking up on some of those questions now as we are heading into our last 20-25 minutes, and that is related to risk. I think you all have spoken so far very little about risk, although I know that's pretty much top of your minds. And the question was if there are different ways to consider and measure risk. And do we know, for instance, how different disciplines, epidemiology, insurance industry, psychology, construct and measure risk that could be considered? Any thoughts from the panel on the risk question?
I don't want to hog the mic, but I'm happy to jump in. I have worked on climate risk for the past 15 years of my life, and specifically, how do you measure and quantify the physical impacts of climate change? So very briefly, what I'll say is we've gone from a world where people were questioning even whether we needed to look at climate models and understand forward-looking data, and then to how we were going to do that, given the shape and form of those models, into a world where we are seeing climate data, forward-looking data connected to short-term forecasts, connected to historical weather data, being slowly but surely embedded into decision-making processes, into banking, credit risk platform from some of the largest financial data providers, thinking of Moody's specifically here, where I worked for a number of years, but also into planning tools for utilities to understand where they should do their retrofits first, a very detailed geospatial mapping of how drought or fires may be affecting land use and certain terrains, and where to be most effectively applying irrigation in the event of a drought. So we've really moved in a world where the data has become widely available, and importantly is being applied very specifically to particular issues so that they can enable decision. And so we've come a really long way. Those practices are not necessarily widespread. They're not necessarily widely available, in particular in emerging markets and developing countries, but we've really have the tools, and if we can deploy those, then we'll be able to support much better decisions.
Thanks, Emily. Go ahead, Greg.
No, let Elvira go first, and then I'll go next.
Okay, good. Thanks, Greg. I would want to build on what Emily now said. I think on the one hand, it is underappreciated what a paradigm shift it has been in terms of availability of data solutions now. And Emily has just named a few, but it is happening at the largest scale. And I think that is a market signal we should also react to, because if people work on these solutions, they see a market for it. And this market is absolutely rapidly developing, sometimes aided by regulation, by policies, by requirements, but also simply by the fact that if you look at certain corporates who depend on water, mind you, they will know what biodiversity risk and nature risk and climate risk is out there, because that's their daily business. So they will invest in tracking and tracing this and understanding this better. So I think there is sort of a revolution out there in terms of the availability of this, but at the same time, the data and digital divide is getting bigger. And I'm slightly unhappy, not to use a stronger word, that there is not more recognition about this, that this is a decisive moment for emerging economies and the global south, because only the very affluent or the very established corporates or banks can afford this. Or central banks, etc., but in the absence of good budgets, they cannot. And I think it should become more of a public good, or at least a subsidized good, so that it's really massively available. And likewise, those companies that go into the development of this, they also need to be de-risked. There's still too many companies out there who, I mean, not everybody can have the trajectory that Emily had, but there's so many who invest heavily on the software development, and then they get stuck because of follow-on funding is not coming. Somebody else has a more mainstream thing, but these investments are really, really important. To go back to what we said earlier, information, data is the currency in which we all trade, and in the absence of it, we will not find investors to go into this area.
That actually sets up perfectly for what I also wanted to say, which is I think, you know, from the nature front, there's been, I mean, for years we've talked about risk to nature, and very little has been done at the systematic level around risk from nature loss. And I think individual corporations, you know, they understand their business and they know, you know, they know their risk from, you know, a lack, if we lose pollination services, right, or if other natural infrastructure is lost. For the most part, I think at the systems level and even at some of the investor level in the global south and national development banks and the like, that dependency on nature is not very well understood and quantified. I think we're starting to get there, and I think there's some kind of very nascent initiatives to understand that in certain countries. But I still don't think that it's something that's well integrated or well kind of taken in the decision-making process, partially because the data is not necessarily there. Maybe it's held by corporates, but it's not publicly available, or it's not integrated across sectors. At the IDB, you know, we're starting to do an internal dependency risk on nature for our portfolio. I know other MDBs are doing the same. I think we've also worked with some of the national development banks to do a toolkit to help them apply TNFD to their portfolios, and I think, you know, in a simple way, so that they can begin to understand those kinds of risks. But I do think that's an area that requires a lot more work. And there was a question previously about flood insurance, and you know, one of the things we did at the IDB was looking at the Mesoamerican reef and valuing it for its coastal protection value, its tourism value, its fishery value, its non-use value, and then working with insurers and others to basically ensure the reef is as a natural asset and natural infrastructure, because that reef is providing massive resilient services to, you know, not just the country, but to coastal landholders, to low-income populations, and we need to start to think about those services and actually have a dollar value on the services that this kind of infrastructure is providing, and look at the risk of losing it, because replacing it with built infrastructure later is going to be incredibly costly. And it's not quite an adaptation argument, right? It's a nature loss and biodiversity argument, which is a slightly different argument to be made to both the investors and the asset owners. So I think that's we're moving in a slightly different direction with this now.
Mary, yes, please go ahead.
Yeah, one of the things that we do at the fund level, at our portfolio companies level, is that we run annual surveys on farmers to learn more about how they were impacted, not only about their livelihood, but also about their climate resilience. And to measure climate resilience, we actually try to understand the risks associated, their ability to absorb a shock when it happens. And this is where insurance becomes very important. And of course, the lack of crop insurance makes most of our farmers not being able to absorb any climate shock. We also measure their ability to adapt. And here, the idea here is trying to understand the impact of different business models on the climate adaptation and resilience of farmers. Because see, climate mitigation is, I love it because it's, our sister fund, their scorecard mainly is like one number. It's how many tons of greenhouse gases they saved, and people understand it, people grasp that concept. But once you start talking about climate adaptation and climate resilience, actually, in many cases, it means different things to different people. So we're trying to standardize it even for ourselves, so that when we report to our investors and different stakeholders, we have a reference point. We have a framework that we say, okay, this is what we are reporting on. These are the risks associated with climate change for the farmers. This is how farmers are this is the kind of enablers for them to adapt, and these are the challenges and risks why they cannot absorb. We make this kind of scorecard and data available. We know that we have more data than what we analyze, and Emily, to your point, data is very important, and decision making based on data is extremely important. We're trying to learn more about what we are doing and learn more about the different business model and what they mean for climate adaptation. But it's still, I don't think, at least in the ag space, I don't think we have like a gold standard where everyone agreed that this is the way we should be measuring it, and this is how we're going to assess the risks.
Thank you, everyone. I think really complete picture emanating from the four of you of how one can look at this, and clearly there is a lot happening in the data space. I am hearing some interference here. And so I'd like to slightly change tack, picking up on some more questions from our audience. And one of the questions is, when you consider supporting private investors financially, or with TA, for instance, do you explore whether the project investment is sustainable and scalable beyond the end of your financial engagement? Again, your financial engagement depends on where you all are coming from, but any thoughts of that? What's your horizon on this for scalability? Anyone wants to tackle that, Emily?
I'll take a pass. From a pretty niche perspective. We invest in early stage companies, and so of course the scalability is one of the key things we look at, because otherwise we're just throwing money out of the windows in terms of what will happen to that company, and that's just the standard way of looking. And we don't support necessarily private investors. We support companies directly, but having an understanding of what are the paths for the company to scale, whether directly or through partners or through acquisition, and what are the paths for the company to secure growth capital is very important. And I think that's one of the problems in adaptation investments right now, is that there isn't this clear path that we have in mitigation from, well, you get this kind of investors and then you grow up and you can access this type of capital, and then you move into loans or project finance to build more infrastructure like projects, and that clear path and how you progress through the capital stack isn't established. To Tamer's point, we're still figuring out what are the business models and therefore what are the right way to support them financially.
Thank you. Anyone else on that topic?
Yeah, just one quick point to add is we invest in companies that are either profitable, about to be profitable, or have clear path towards profitability, because sustainability of the business model is essential. Otherwise, we don't invest in the company, as Emily mentioned. And it's not about the economic sustainability during our holding period. No, even after we exit, because if it's not sustainable after we exit, no one will buy it. Hence, there is no exit for us. So economic sustainability is essential, and without scalability, it becomes a nice small lifestyle business, and we don't invest in that. We invest in companies that have the potential to grow. So that's essential. And the notion of investing in companies that will keep burning cash until they reach a few $100 million of revenues to reach profitability, unfortunately, we can't afford it in Africa, so we don't do that.
Thank you, Tamer, which takes me to a related question that we got from the audience, and you actually got right into that. The question is there anything special about adaptation and biodiversity private sector engagement that's different from the more general effort to mobilize more private sector engagement for development? And what you just said is it has to be profitable, no matter what it is, because otherwise you will not have the private sector coming in. Am I paraphrasing that correctly? And anyone, you or any one of the others who wants to build out on that, on the need to have a return? I know that a couple of you had already touched on it in your earlier interventions.
I mean, I could come in on that. This there might be exceptions to this, but I cannot come up with examples right now for that. But generally, there is a proven correlation between the economic success of something and what the outcomes of that venture are. So if you have a sustainability-minded management, proven management, or talented management, also the outcomes of that company will generally be better. So I think striving for success as a function of a competent management, a competent design, a competent strategy, adherence to standards, compliance, etc. I think all of that we need to see together, because only then will you do your best in your given context, and only then can you attract investors to entrust you with their funding or their capital. So I really think it is vital that we don't sink money somewhere in something where we haven't given our best aspirations. Now, that doesn't mean that certain things don't need to be highly subsidized, but they need to be lasting. They need to be sustainable as a project. They need to make sense. And if you touch private investors, if we now leave out philanthropic objectives, if we talk really about private investors, then I think there's absolutely no other way than to go in with the intention of building something that stays. Is that in the literal sense or in the proverbial sense? So yes, I think that typically economic success goes hand in hand, and I don't mean maximized economic success, but economic success goes hand in hand with SDG outcomes, to put it into a more general context. And to filter for such teams, for such projects, for such strategies, that's our job, and that is vital, so that we also allocate capital in the right direction. If you can achieve a CO2 reduction of 60%, you should rather go for that in a large scale project than achieving just 20%, right? That's vital. To use an easy metric, I know we are still in the adaptation space, but there's something to say for mitigation. I agree with you, Tama.
Thank you. What I'd like to do is we will stop really at half hour point, wherever that is for our audience. And so what I'd just like to do is what we had really tried to do, and you are just a wonderful, fantastic panel, is we really wanted to bring you as practitioners who really are trying to achieve scale in the real world with real people on real topics, and bring that to our audience on both the climate adaptation and the link to nature side. And I think you have provided a really great menu for people to see that there is a lot of movement. This is happening. There is a lot of money flowing into it. It is not just something that one theoretically talks about, but you are all working on that and you are being successful in that. So I'd like to give you the opportunity each to take 1 minute just to say if there's anything else or any key point of this conversation that you would like to highlight to our audience and on the way going forward, and in this very constructive and positive spirit that you all have conveyed over the past hour and a half. If I may, I would start with, I would do it in the same order as we had our opening questions, and that would mean that I would start with Emily. Emily, 1 minute.
And a surprise question. I think what comes to mind for me is the need for people to have an open mind when they think about adaptation and resilience solutions. They are going to be really important solutions that come from working with nature and biodiversity. There are going to be very important solutions that come from leveraging indigenous knowledge, from leaning on local communities. My hope and expectation is that there are also going to be really important solutions that come from novel products and practices that we haven't even thought of yet, and that are going to help some of the problem. Not a silver bullet, but in specific issues and markets and pain points and challenges and hazards, that we're going to have new ways to deal with those that are going to help us do a lot more with what we have and protect more lives and protect livelihoods more broadly. And so when thinking about investment opportunities, I think for the visionaries out there who want to be part of that effort to develop also to develop also products and solutions that are going to really leverage innovation, there are going to be a lot of opportunities.
Thank you. And Greg.
Thanks. I guess for me, I think the point is, I get the sense sometimes in conversations, people are looking for the silver bullet, one finance solution that will solve everything. And when we're having conversations with clients, what we're trying to say is to focus much more on the menu of solutions, and that there are multiple different kinds of financial interventions and financial products. They're not all applicable to the same ecosystem or the same problem or the same country. And we need to be very aware of that and very open to that and okay with that, and that we can look at the menu, look at the problem. And then also, I think the area that's not so explored so far is how we can layer products together, because we can have a debt for nature conversion that also potentially has a biodiversity credit attached to it, and understanding that where you can and where you can't combine products to have a holistic approach to crowding in multiple sources of finance to solve a problem, I think is an important perspective to take, because it's not one product that's going to solve everything. So I think that's my closing message.
Thank you. And Tamer.
Sure, and that Gregory, I cannot agree more with you. You know, that silver bullet doesn't exist. One of the things that we've been seeing happening, and people are getting more and more interested in, is blended finance, blending philanthropic money with first loss layer coming from foundations or international organizations, mixing that with pure commercial funding, allowed funds, including ours, of course, to do things that otherwise will not be doable because of this notion that no money makes money in Africa. Or no, sorry, nobody makes money in Africa, or nobody makes money in ag. Those, using broad brush to taint a region or a sector, where there are people who are making good money in Africa and there are people who are making good money in ag in Africa. So using that blended finance allows all of us to do things that otherwise will not be doable, and we need more of it. Thank you.
Thank you, Tamer. And last word, Elvira.
I think that it would be wonderful if we were to deploy more incentives to do the right thing. I mean, the biodiversity loss is unprecedented. The nature emergency is absolutely there, and I think setting incentives, is it KPI for staff? Is it policies and regulations? Is it de-risking of private investors? Is it having a school system that rewards students who really are mindful of their environment? Whatever it is, I think we need to really incentivize this positive behavior much more, and disincentivize the other side, of course, and to really understand how many shapes and forms this can have and how powerful that is, because we all perform better when we are being also emotionally rewarded, right? So I think this really matters, and we are not systematic about that yet, when actually it can be really powerful. And also to stop abusing incentives. I mean, I look with worry, and then I'll close. I look with worry sometimes at the hype that blended finance is, because it has also created expectations that only if you are significantly de-risked can you go into emerging markets. So we also have to counterbalance that again, to have a more granular view on these things. But I think incentives matter, and transparency matters.
Thank you, Elvira. And thank you all on behalf of Matt and myself. You've been a wonderful panel. We've had questions with you all soon again. Thanks again, and thanks for giving us such a constructive outlook at this really complex topic. Thank you very much. This closes the session. Bye.
Thank you.